Hello, this is Chris Hadley with Fairway Independent Mortgage. Welcome to our second video in the series on the 4 C's of the home buying process. Last week we discussed credit, and this week we'll be talking about capacity. Capacity is a broad topic with a lot of variation from person to person. We define capacity basically as your ability to repay your mortgage loan. We judge this by 3 general factors or rules as it pertains to your income. Number 1, your employment history. 2, your job stability, and 3, the likelihood of your job continuing for at least the next 3 years. These 3 factors come from the Dodd-Frank Financial Reform Act, which is a complicated 849-page law that essentially dictates the rules for the mortgage lending world. Relax, no intention of reading the entire law. I will instead just walk you through the things that you really need to know. Just like there are 3 rules, there are 3 general ways to earn a living, and the rules are different for each one depending on which category you fall into. They are, number 1, you earn a salary or an hourly rate. This is by far the easiest one to analyze. Number 2, fluctuating income, which involves things like commission, bonuses, overtime, part-time work, that kind of stuff. The final one is if you're self-employed, which is a bit more complicated to analyze. Each of these 3 ways of making a living have their own specific rules, but there are also some rules that encompass all 3 ways you may get paid. No matter your line of work, we're going to require a 2-year work history. We also want to see a degree of certainty that the income will continue for at least 3 years. We want to see your income increasing or at worst staying steady. We don't want to see big gaps in employment either. 6 months is what we consider a big gap, so that could create some other challenges. Now that we've discussed general rules, let's dive into some specifics of each income category. As I said before, the easiest to analyze is if you're receiving a salary or getting paid an hourly rate. Here, we just want to see that you're working a consistent 40-hour work week or that your salary is the same on each paycheck. We want to see a 2-year history in a similar line of work here, and we can also count college if you get your degree as part of your work history, which is pretty cool. Unless you have a definitive end date, we will typically assume it will continue for at least 3 years. The next is fluctuating income, which is again involving commission, overtime, part-time work, and bonuses. For most of our loan programs, we have to have a 2-year history here for this income to be considered stable. And what we do here is we simply take an average of the last 24 months and we use that to qualify you. And in order to fulfill the 3-year continuance rule, we're going to require your employer to give us in writing the likelihood of this continuing for at least 3 years is either good or great. Lastly, we come to the self-employed income. You fall into this category if you own more than 25% of a business or you get paid as an independent contractor via 1099. For every loan program, we will require a minimum of a 2-year work history for self-employed income to be considered stable. And unless you've announced you're closing your doors or you're having a going out of business sale, we can assume a 3-year continuance here pretty simply. Capacity is one of the most complicated aspects of buying a home, so thank you for tuning in, and we'll see you next week where we'll be talking about capital.